Hello, everyone. It's Kali Persall, editor of Institutional Investing in Infrastructure, here today with Tyler Rosenlicht, portfolio manager for global listed infrastructure at Cohen Steers. And we're going to talk about how listed infrastructure can complement private holdings in the current market environment. Tyler, thank you so much for being here today. Do you want to just say a few words about your role at Cohen Steers to kick us off before we get into it?
Sure. Thanks so much for having me this afternoon. So I'm Tyler Rosenlicht. I'm one of the portfolio managers of the Cohen Steers Global Listed Infrastructure Strategy. We've been managing infrastructure portfolios for a little over 20 years, focused on listed securities, investing across things like utilities, telecommunications, transportation infrastructure, as well as energy infrastructure we call midstream. So long track record of focused on the listed markets and really excited about the asset class and sort of where we sit for the future.
Fantastic. And thanks for joining me again. I know we talked a few years ago, so it's nice to get an update. So you recently co-authored a report on private and listed infrastructure in the case for a complete portfolio. In your report, you sort of point out that more institutional investors are tending to increase their allocations to infrastructure more than any other asset class. So just wondering, what factors do you see driving these increased allocations by investors across both listed and private infrastructure?
Yeah, so when we think about investing in infrastructure, I think about two things. One is sort of the investment characteristics. What do these businesses and assets do in your portfolio? And then what's the sort of secular outlook and the opportunity for the asset class? I guess on the former, one of the things that we like about infrastructure as an asset class is it tends to have lower volatility and offer downside protection for investors who want equity-like returns, but maybe are wary of, hey, equities are at all-time highs, valuation multiples are high, generally speaking, yields have remained fairly low and credit spreads have remained fairly low. So they're looking for some security, some downside protection, a way to get good equity-like returns, but in a way that's more measured and predictable. And that's really what infrastructure can offer in both the listed and the private forms. In terms of the why now case, infrastructure is in the front page of the news every day. We are seeing the requirements to redevelop the developed world's infrastructure systems. You see outages at Newark Airport because we don't have modernized passenger travel technologies and so forth. And clearly emerging markets are seeing big growth opportunities. There's reindustrialization, there's investments in data centers and electrification and the power that's going to be required to invest in all of that. Changing global supply chains. I could go on, but the reality is a lot of what we're hearing about in DC and we see in terms of trade negotiations and technological advancements, it's going to be very infrastructure development dependent. And I think that's really resonating with folks today. They're looking at ways to, get exposure to a lot of these themes. And we really think infrastructure is a way to do that. And so why are investors increasing allocations? It's kind of the right asset class in the macro environment that we're living in with really robust tailwinds. And finding those combinations is rare. And I think investors tend to get really excited when they can do that.
So how can listed assets complement private holdings, and what benefits can allocations to both offer in today's economic environment?
We think infrastructure is the asset class and infrastructure is infrastructure. The wrapper in terms of how you access it is less important in that what you really want to make sure you have is the exposure to the asset class. And so when you think about accessing infrastructure from listed versus private forms, they come with big trade-offs. And we think there are some, really good complementary elements to listed exposure. What we found in the last few years is most people have gone the private route, and we're just out there saying, hey, listed is a great complement to it. What do you get with listed? You get really good diversification. Generally speaking, infrastructure assets are really big assets. It can be tough to diversify in private portfolios, but listed portfolios offer you the ability to diversify by subsector, by region, by geography. We think that's a big advantage. There are some business types that we think, in the listed forms, you get superior exposure to. things like freight rails. Generally speaking, we think freight rails are better accessed in listed markets because there's really six of them that are publicly traded, and it's tough to round out your infrastructure portfolio if you only take a private lens to it. I'd also say we think listed is, liquid in that as a manager, we can access new themes and we can sort of migrate the portfolio a lot more quickly than you can in private forms. And as the world is changing fairly quickly, that can be an advantage. So it's not to condemn private by any means. It's to say, hey, private offers certain characteristics, listed offers very different ones, but we think they can complement each other. And investors should really look at infrastructure as a holistic asset class and utilize both wrappers as they think about getting exposure to the industry.
Yeah, so piggybacking off of that a little bit, there seems to be a misconception looking through your report that private infrastructure consistently outperforms listed infrastructure. So what is the reality and what role have things like interest rates played in this in recent years?
One of the key takeaways from our paper is this, idea or this evaluation of what have the returns of listed infrastructure and private infrastructure been like over time. And the conclusion would be they've been basically the same. You can look at long-term histories of listed and private, and you get basically the same absolute returns over the course of the last 20 years or so. That makes a lot of sense to us because generally speaking, though there can be differences, the underlying investments and assets are fairly similar. So in the very long run, we have observed, and we would expect to continue to observe fairly similar returns across listed and private infrastructure. In the very recent history, the last 2 or 3 years, you've actually seen listed infrastructure underperform private a little bit. That makes sense to us because generally speaking, listed reacts a little bit more quickly to changes in valuations, changes in interest rates, and so forth. And you can see more of a lagged effect on valuations in private markets. So, interest rates specifically, what's happened? They've gone up a lot. We would argue that that's affected infrastructure valuations similarly, but you see that observed in listed securities more quickly. And we would expect to see over time, maybe that will weigh on private infrastructure returns, or listed will sort of catch up as we've over discounted the rise in interest rates. So the punchline is infrastructure is infrastructure, listed and private returns, very similar over time. And that makes sense to us. It's about the asset class, and the underlying sort of ways to access it can differ, but those differences tend to be more shorter lived in nature.
So you talk in the report about dry powder a lot. How can listed infrastructure help unlock that buildup of dry powder that is currently existing within private infrastructure funds?
One of the really unique things about infrastructure as an asset class is, scale can be really helpful. Owning large assets can be a big advantage, both from an operational expertise perspective, a management capability perspective, an access to capital perspective, a ability to finance, and so forth. What we've seen is lots of infrastructure assets have been acquired by private firms over time. They're now looking to monetize those assets or sell them, right? It used to be that lots of transactions were happening between private sellers and private buyers. We do think listed companies will be a great buyer going forward. Generally speaking, their access to capital is very robust. And again, scale and size can really matter. So as private owners look to sell their assets, we do think the listed companies will, garner a higher market share of acquisitions going forward. Not all acquisitions are great, but generally speaking, good management teams that can find good acquisitions that are accretive and make sense from a business and fundamental perspective, those can be really, really good transactions. The bid-ask spread has been fairly wide. Publicly traded companies have been very disciplined. We do think sort of auction values and prices are going their way. Things are getting a little bit less expensive. That's going to unlock more and more opportunities. We as active managers are trying to find the best stewards of capital, and to the extent that they can, again, the public companies can be smart acquirers going forward. We think that can be a really good opportunity for listed securities and infrastructure going forward.